morning, and thank you and welcome to Capital Wealth Planning's Town Hall with our Chief Market Strategist, Jeff Saut, and our Founder Chief Investment Officer, Kevin Simpson, hosted by the President of Shillin Wealth Management, Michael Shillin. I am Keisha Sandrini, the Director of Advisor Relationship Management at Capital Wealth Planning, which means I am the liaison between our partners across the country, like Shillin Wealth, and Capital Wealth Planning's home office. Capital Wealth Planning is a $1.6 billion boutique 5-star Morningstar rated SMA firm based in Naples, Florida, where our portfolio buys high quality blue chip dividend paying stocks and couple that with a tactical option writing technique to target a 5 to 7% cash flow between the dividend yield and option premium. And in these tumultuous times, this might be an attractive alternative to many investors. We have been fortunate enough to have Jeff Saut join our firm last year, and with his decades of knowledge and experience, along with his insightful perspective, who I like to call the finance historian, our firm and our partners alike will greatly benefit with this new alliance. Our founder, Kevin Simpson, has been the Chief Investment Officer since our establishment 15 years ago. And with having over 30 years of industry expertise, he is one of the most sought after and accessible money managers out there. Both gentlemen will have been on several national media outlets like CNBC, Fox News, and Yahoo, just to name a few. And they will be answering a few questions towards the end of the call. Now, without further ado, Jeff and Kevin.
Thanks, Keisha, and welcome everybody to a pretty historic decline. I have been in this business for nearly 50 years, and my dad was a portfolio manager, so I've been looking at markets for 56 years. And quite frankly, I've never seen a decline this big, this fast. And I went back and looked at history, and I don't think maybe in 1929 to 1932 there was, but I wasn't around back then. So for those of you that don't subscribe to Saut Strategy and our weekly letter, I write on Mondays. My right-hand guy, ex-Raymond James associate Andrew Adams, writes on Wednesdays, and another ex-colleague, Harry Katica, writes on Fridays. I actually, on February 13th, wrote about that. I have three indicators or models, I should call them. The long-term model flipped positive in 2008 and has never flipped negative since then. The intermediate term and short-term models obviously flip more often than that. And on mid-February of this year, the short-term model flashed a sell signal, and about a week later, the intermediate model flashed a sell signal. We actually wrote about that in mid-February and told people to sell trading positions, all trading positions, and to raise cash. And I actually raised 30% cash, which in retrospect wasn't enough. But quite frankly, I didn't think the decline would be this severe. As I said, I've never seen a decline of this severity come this quickly. So going into last week, there were 8 what we would call 90% downside days within an 18-session period. I've never seen that. I think it happened in the 1940s, but I personally have never seen that because I was born in 1949. Now, a 90% downside session is the reciprocal of a 90% upside session, meaning 90% of the up to downside volume came in on the downside, and 90% of the plus to minus points traded also came in on the minus side. And that's pretty historic. And then last week, it was followed by, on Tuesday, a 90% upside day, and then 2 80+% upside days on Wednesday and Thursday before you got whacked again on Friday. And so I actually think the bottom was made on March 23rd. I think it was at 2191. And in that throwback rally, which was pretty extreme, I mean, we had like a 17, 18% rally off that low. And given that the market was no longer at historic extreme near-term oversold conditions, The Fed and the federal government had already announced their stimulus measures, and the pension fund quarterly rebalance was at its end at the end of the quarter. So the fact that we peaked and are now in pullback mode, suggests that you may get a retest or a slightly lower low. That's how major lows are made. You get a low, you get a throwback rally, and then typically you come back down and retest. Sometimes you get a V bottom, but I've only seen one of those in my 49 years in this business. And a lot of people worried about earnings. The average peak to trough fall in S&P 500 operating earnings has been 26% over the 6 largest declines since 1980. Assuming a similar impact would put the current S&P forward multiple at roughly 17 times earnings, which is an average level over the past 5 years. That's not depressed, and it's above previous recession lows. Our estimate for the U.S. equity risk premium using cyclically adjusted earnings is actually at 5.3% right now, which is still below the peaks reached in the global financial crisis and the Eurozone crisis. That said, one of the things we need to find out is how governments may shield companies from the fall in gross domestic product, including some proposals to pay salaries for workers or allowing people not to pay taxes. I'm a buyer here of stocks. I think valuation metrics are attractive right here. I think you have to take it on an individual stock basis. And if you want to talk about individual stocks, we can. But I think we've seen the worst of the decline. I think you're seeing a peak. I just got an email from a reporter I know at the New York Times that's telling me they think the cases of the coronavirus have peaked in New York City. And I think with when the cases of coronavirus peak, I think the market bottoms. So I think we had a 37% decline from intraday high to intraday lows. And while a lot of people are saying, it's a rally in a bear market, what we've seen is just a throwback rally after a bone-crushing decline. I don't believe it. Secular bull markets tend to last 15 or 20 years. They're not stopped by a 20, 30, even 40% decline. I mean, the 1949 to 1966 secular bull market had a number of 30+% declines. The 1982 to 2000 secular bull market had the 87 crash. But the secular bull market went on for another 13 years. So these people that tell us that this is the longest bull market in history certainly have not studied market history, because the history of secular bull markets is that they tend to run 15 to 20 years, like the 1949 to 66 or the 1982 to 2000 secular bull market. So I know your clients are scared to death. They didn't manage risk. The key of being a successful investor, as written by Benjamin Graham in the book The Intelligent Investor, is captured in this quote by Ben Graham, where he says, "The essence of portfolio management is the management of risks, not the management of returns." And he closes that thought by saying all good portfolio management begins and ends with this premise. And the problem is people don't manage risk. They say it'll come back. Well, Eastman Kodak didn't come back. Enron didn't come back. So you may get whipsawed, but somewhere you've got to have an uncle point of somewhere around, in my opinion, 15 or 20%, where you go, okay, I'm done with that. I'm out. And it may bottom right where you sell it and turn back up, but that's managing risk. And I'm telling you, folks, if you manage risk and avoid the big loss, the upside will take care of itself. And that's one of the things that we do very well at Capital Wealth Planning. With that, I'm going to turn it over to Kevin.
Thanks, Jeff. It's always a treat to get to hear your market history, and I talk to you every day, and every single time I learn something. So thank you for that. I'll challenge you on one comment though, because you're certainly not old enough to remember that V bottom of 1906. So I want to make sure people know that you're young and healthy and not 120 years old yet.
You're too kind.
Well, the idea of that March 24th bottom is, I think, a very key point. And I like what you said also about the fact that markets don't typically have a V recovery without some type of retesting. And when we think about where we are in this completely unprecedented space, the decline of the market makes a lot of sense in hindsight, because what does Wall Street hate more than anything is uncertainty. And if we have no idea what we're faced with, you assume the worst. You can't calculate earnings projections or economic data projections. I think we were all expecting the unemployment weekly number to be really, really big today, but to see it exceed 6 million was probably an even bigger reality hit than any of us expected. But the great thing is that we all know this is a temporary situation. So I love the statistics that you were talking about, Jeff, regarding the virus. It's not something that I know much about, but I do agree completely that as cases peak and we begin to look at the other side of things, the great news is that stock markets tend to recover before economies. The challenge we're faced with is how long before things can restart, because we were in such a great place heading into this. I mean, the consumer was so strong. Housing starts were phenomenal. Interest rates were low. Inflation was low. I mean, everything was really in a great place, and you turn it off on purpose. Who would have even imagined that something like that was possible? And as we get through this long April of seclusion, I think the consumer is going to be anxious to get back out at some point and begin the restart of this economy. Hopefully we have enough, hopefully the financial package is enough to keep small businesses and people through this, and that we will have restaurants to go to and money to spend when it's over. The news media is going to play this up as they should. We're going to see a lot of pretty scary things health-wise over the next 2 months. And hopefully, to your point, Jeff, the peak is happening now, or maybe over the next 2 weeks, and then things begin to look a whole lot better. But when there's fear in the markets, as there will be, we're going to see continued volatility. And if we retest the low, and you said that's a possibility, it's not a hard and fast S&P number. I forget what you said on March 23rd. I think it was like 2190, 2191 in that range. But if we go a little bit below that, that's not uncommon considering the market history that you just taught us. But the good news, again, is that's how markets bottom. And when you call the market bottoming process and the beginning of that, I don't think there's a person out there that would disagree with you. The best case scenario is a U-shaped bottom, the bottom that begins to recover, where maybe even in the fourth quarter we start to see things really looking like they're back to normal. And from our standpoint, we're all hoping for that to happen. Now, hope isn't an investment strategy, but it's not a bad thing to have some optimism. So when you think about the investment strategy, Jeff, you quoted Ben Graham. You talk about managing risk and managing the downside. What you want to own coming through this is probably the same companies you wanted to own before this happened, and 10 years ago, and probably 10 years into the future. Great, high-quality companies with really strong balance sheets. And when we look to think about how we build our portfolios, it's built right on that foundation. Some of those companies are completely discounted at this point because we're not spending. The consumer can't go out there. Interest rates at zero. It makes the financials, very, very attractive at these levels. We own JP Morgan, we own Goldman Sachs. For now, there's a lot of talk about the banks, how strong their dividends are. Those two companies have very powerful balance sheets. We own Chevron in the energy space, which is a company that, I guess until today, if we see a support in this oil increase, it's probably the only name in the energy space we would consider. Everyone else is leveraging to pay dividends. They're one company that has a strong cash reserve that can continue to support that dividend over the foreseeable future. Now, they can't pay to perpetuity. They don't have an unlimited bank account, but if energy prices get back up over 30, at some point $35 a barrel, then they can sustain it for the foreseeable future. If they float around 18 to 20 to $22 a barrel, then we're going to have a problem. You look at companies like Walt Disney. The parks are closed. The movie theaters are closed. There's no sporting events. It's just very, very powerful balance sheets. Companies that at these prices can get through. We're going to look back in 1, 2, 3 years and say, man, remember how attractive those markets were. Just like in 2008, the Bank of America probably got down to $2 at one point in that fiasco. But McDonald's, Home Depot, just really, really high quality companies that are undervalued for obvious reasons. And the sooner we can get back to normalcy, I think the better we're going to be able to recover. But the great thing from our standpoint of how you invest in these markets, specifically with stocks and equities, is that we want to invest in the best companies in the world and get paid while we wait. And I think that's the mantra of what we're trying to do here, is looking at where we are, where we've been, how we're going to get through it, and the type of quality that will help while we're going through what probably will be a little bit painful 4 to 6 week period. I love the idea of the market, having resiliency and some strength to it, but headline risk and uncertainty still are going to weigh in the short term. Mike, I'm not sure if you're muted or not, but we kind of monopolize a lot of this conversation, and I know everybody wants to hear Jeff and not me. But if you're not on mute, I'd love to kind of have you say hello, say a few words, maybe direct us on where we can go, and then Keisha can see if there's a few questions.
Sure. Can you hear me right now?
Yeah, you're good.
Yes.
All right. First off, I want to thank both of you for taking time to do this. I know these are crazy times in our industries, and your time is very valuable. I've worked with Kevin now, what feels, it's crazy to say this, for almost 5 years, going back to my time at Raymond James and now running our own firm. I know this is probably a very broad question, but we're very much a high-quality dividend-focused shop. And I guess, a lot of people on this call, Kevin, frankly, use the CWP strategy, whether it's the SMA or the ETF. Can you maybe just talk about why dividends and calls are so important in this type of environment?
Sure, Mike, and it has been 5 years. It's crazy. The power of dividends, as you built your firm on, and as Jeff can attest to, are just indicative of great companies that take great care of their shareholders. Now, we need to make sure that it's not just dividends. For us specifically, it's companies that have a history of increasing their dividends and then making very certain that they're increasing their dividends for the right reasons. They're increasing their dividends because they're increasing their earnings. Generally, those companies are going to do really well over time from an investment standpoint. And again, kind of revisiting our mantra of getting paid while we wait in periods when markets are flat or down. Companies that leverage their dividends, anybody can pay a dividend. Any of us can buy anything we want on a credit card. Exxon borrows to pay its dividend. To us, that's not a good long-term plan. So we own Chevron. But dividends to us are a very, very core foundation of quality investments. It's not the only way to invest, but it's how we do it. And it's not a question of high dividends. Again, it's really a concept in companies that over the years have a history of increasing dividends. And in our portfolio, the 5-year dividend growth rate is about 13 to 15%. Hopefully, none of our companies are going to increase dividends this year. They need to maintain the dividend yield that they have, which would be great. but nobody has to stretch anything and try to be a superstar when the economy's closed down. Mike, you also mentioned covered call writing, and I didn't want to make that a top priority in today's call. I really want to hear Jeff talk about where markets are headed, but the importance of covered call writing in a volatile or down market is so important, because not only are we getting paid from the dividends, we're also getting an income stream from the option premiums, which in markets where we have heightened volatility, and maybe that's an understatement here, but it was a complete free fall. Jeff, I think you coined the term waterfall decline, but we're able to help also buffer the downside of the market pullback by increasing that income stream, so that the current cash flow with dividends and option premiums in our portfolio right now is annualizing out. We're going to sell a call in Chevron today, and it's going to be over 8.5% annualized. So recognizing that stock prices go up and down, and we like them a lot better when they go up, but knowing that we've got really strong companies, and then combining that with a covered call cash flow, so that you've got an 8 to 8.5% annualized income stream right now, that definitely helps to buffer that downside. Our downside capture in the first quarter was about 74%. So we're still in the stock market, still suffer when markets go down. But if we're down 25% less than broad market, it's a little bit easier to pull the climb out of. And again, kind of banking on the fact and really paying attention to quality, you can be less concerned about the market's fluctuations. You can sleep a little bit better at night. Because even though Disney World's closed right now here for us in Florida, I know you're in Wisconsin, it might be a little bit colder and hard to picture sunny Florida. But soon enough, you'll all be back down here enjoying it and going to movies, and the Brewers will be out playing again, and we're going to return to life as normal. This is a temporary scenario, and that, I think, is the most important thing to kind of keep in mind right now.
And I hope you don't mind. We're getting some client questions, and these can be directed at both you and Jeff, but one that's very repetitive, and I know neither of you can answer this with 100% confidence, but where do you see the direction of all of this going? I mean, obviously with businesses shut down, the economy sort of on hold, what is your timeline for when you both see markets and the economy starting to somewhat stabilize a little bit? And to be a little more defined, what is that? What is your definition of a new normal?
Jeff?
Oh, that guy, Mohammed Alarian, has been talking about a new normal for 5 years. I don't know why the CNBC keeps having this guy back on CNBC. I think I know him. I've talked with him when he was at PIMCO, along with Bill Gross, and he's been talking about the new normal for 5 years, and there is no new normal, by the way. I'm 70 years old. I've been looking at markets for a long time. Most of the time when something like this happens, there's some historic frame of reference that you can draw on, but this is unprecedented. I've never seen anything like it. I think the whole thing hinges, in terms of the economy, the stock market, and investments, hinges on the question, when does the virus peak and when do cases start to go down? And the people I talked to at the CDC, I lived in Atlanta twice, and I'm still pretty well connected in Washington, D.C. on Capitol Hill because I've lived there twice. And the best guesstimate, and that's all it is, folks, is a guesstimate, is this thing peaks by the end of this month. And things start to try and normalize. And if that's the case, the stock market's bottomed. And if you get any kind of announcement, and you're starting to see things out of New York about a vaccine or a cure or things like that, then for sure the bottom is in. But my best guess is we'll be past the peak by the end of April. And I just saw where I used to live in Virginia, the governor put everybody in a stay-at-home until June 10th, which I think is crazy. I think that's way beyond the pale, as my grandmother used to say. I'm not quite sure what that means, but that's what she used to say.
And on that note, this is Mike again. And this kind of piggybacks on what you're talking about, Jeff. And I get this question, I can't even tell you how many times a day is, none of us can accurately pick a bottom. Some people think that this is going to drag out and cause a new depression, cause economic events we've never seen. I always try to just provide rational thinking because I know that it's hard to do that sometimes. But as an investor, what would you recommend people be doing right now?
I'd be buying Capital Wealth Planning. I'd be putting money with them because in the long cycle, I mean, if you look at the stocks we own, I mean, Goldman Sachs, the stocks we own, what do we have, Kevin? We got like 27 positions on right now.
Yeah, we usually have between 22 and 25. They're all blue chip, high quality names. I mean, we all know these companies: Apple, Chevron, Disney, Goldman, Home Depot, J&J, J.P. Morgan, McDonald's, Merck, Microsoft, Nike, Pepsi, Procter & Gamble, Visa, Verizon, Walmart. I mean, maybe that's more than a few, but gosh, don't they sound like companies that are going to be thriving again when we get back to normal? And I love what you said, Jeff. There is no new normal. There's just normal.
Yeah, and I think it's important to touch on this. I came into this business making markets and puts and calls in 1971. So I'm pretty versed in options. And I promise you, if you buy and try and trade options, you will lose money over the long cycle. But if you use options and sell covered calls, it really increases your downside in terms of protecting at least some of the downside. It increases your income. And I think it's important to note that unlike most option writing funds where they buy a stock and they immediately sell a covered call against it, we don't do that because the problem with that strategy is when the market rallies, they get called out of their position. So we tactically sell, and Kevin can speak to this better than me, but I think we've only got calls out of the 20-some odd positions we have. I think we've only got covered calls, and they're short-term, 1 to 2 month out-of-the-money calls written against 7 or 8 of those positions. Is that right, Kevin?
Yeah, Jeff, heading into the week that was the case, but now with volatility continuing to be massive, we've got 12 covered calls on, and we're in the process of trying to write one on Chevron again today, which would take us up over 60% of the portfolio with covered calls. And we haven't had that many options written in probably a couple of years. And that's just really, an outcrop of when volatility is in the markets, when we need this income the most, when we need this modest insurance and downside protection, they really do work best in these markets. Just like you had mentioned, in a rising market, you want to be really careful. You don't need to just kind of run into a highway to pick up a nickel. So our options, the number of calls that we had written in December when you were very bullish on the market was 0. And now we're over 60% covered. We will be by lunch. And that's helped us to participate a little bit less in the downside. And we'll keep doing it each and every month while I am expecting this heightened volatility. So we're working really, really hard. And since February 19th, there hasn't been a day that we haven't been out there writing options and selling a little bit of stock here and there, and adding a little bit to some of the underperformers, doing a little bit of rebalancing. Because you had made some good calls in January and February about the market, we in this portfolio did have 13% cash. I know in Saut Strategy raised a little more, but we're not market timers. We've got to be fully invested. Having 13% cash heading into February has allowed us to redeploy. Maybe we were a little early too in some of the names that we added, but we got rid of Boeing back in February. We batted Apple. And I think we have just a great lineup to kind of go forward with.
Great. One more question for me, and then my Vice President Jake wants to forward on some questions too. This one is one that a client just asked for you, Jeff. What the federal government's saying that other larger cities are going to go through the same thing that New York City is going through. How can we be optimistic that the market is going to rebound so quickly?
I don't believe I said the market's going to rebound that quickly. Bottoming is a process. And usually the process is you make a low, you get a throwback rally, you come back down and test the lows or make a slightly undercut low, and then you slowly rebuild. There's no way of analyzing until you can figure out how long before the cases of the virus peak. You can't analyze how the impact is going to be on the economy. I was at $177 on earnings for this year. I'm down to $160. But even using that, if that's correct, we're trading under 14 times forward earnings. Stocks are not expensive, and especially the kind of stocks that we buy are not expensive. And the kind of stocks we buy have had to increase their dividends by 15% over the past trailing 5 years. So those kind of stocks or companies are going to do well. And you're going to look back, folks. You're going to look back in 2 years from now and go, how could I have been so stupid not to buy stocks when they got crushed by almost 40%? I mean,
what did your dad say, Jeff, about cheap stocks?
My father used to tell me, son, good things tend to happen to cheap stocks. So I was in the business. The first strategy letter I ever penned was in December of 1974. And I said, stocks are trading below known values. You were trading below book value on the Dow and the S&P. You had 8% dividend yields on the Dow and the S&P. Nobody wanted to buy stocks. 1982, nobody wanted to buy stocks. Right now, actually in 2003, nobody wanted to buy stocks. 2008, the majority of stocks bottomed in October of 2008. 92.6% of all stocks traded made new annual lows on October 10th of 2008. I've been looking at markets for 56 years. I've never seen that. I'm not sure it's ever happened. It's a 7 or 8 standard deviation event. It is not supposed to happen in your lifetime. Nobody wants to buy stocks now. The people that didn't heed our raise cash call in January of this year, in fact, I'm getting calls from financial advisors, and it's not just Raymond James. It's Wells Fargo, it's UBS, it's Merrill Lynch. And the advisors are telling me that their clients that are always wrong at inflection points, they always want to buy at the peak and they want to sell at the low. They're liquidating their portfolios, and that started last week, which is when I think stocks bottomed. So, despite the virus, and again, the people I talked to at the CDC, the people I talked to, because I lived in Baltimore. Actually, I lived in Annapolis, but I have very deep contacts at Johns Hopkins. And the best guess I can put forward is that this virus peaks at the end of this month and we start to normalize. Does that mean the market's going to go straight up? No, it doesn't mean the market's going to go straight up. But what it does mean, it's not going to go down a whole lot more.
Kevin and Jeff, this is Jake here. I appreciate the time. I have a couple of questions on my own here that I'd like to run past you guys, and then a few from clients as well. So I know you guys have touched on the dividend component quite a bit here. And ordinarily, when a company suspends dividends or cuts dividends, it's seen as a pretty big negative in the market. But obviously, these are different times, and that perception is different now. So I guess my question would be, coming out of this, is there any talks that dividends as a whole won't be increasing in the near future as much as or as ordinarily as they usually do? Or can we expect dividends to kind of stall for a bit from these companies as they shore up the rest of their balance sheet?
That's a great question, Jake. I think we're expecting companies to maintain but not increase their dividends. And we saw that with Chevron last week, where they said, look, we're going to cut down on share buybacks, which I think you'll see just pretty much across the board. We're going to tighten our belt on CapEx. We're going to shut down some of our third-party vendor expenses, and we're going to maintain the dividend. Goldman Sachs came out the same commentary this morning, and I think dividends increasing in this environment would be irresponsible for shareholders. We don't need companies to increase their dividends each and every year, especially in light of something like this. But what I think you'll see more of is a suspension of share buybacks so that the companies can support a dividend. They realize that their investors are just that. They're investors. They're not speculators. They're not traders. And as an investor, they want to benefit from the income and the earnings of the company. So I think at least in our space with this high quality, blue chip world, we're going to expect that these dividends remain and continue, and we'll see a big suspension in share buyback.
Kevin, I'll send you a chart on that because here it is right here, snapshot, print screen. I'll send you a chart on that right now if you want to share it with anybody because dividend buybacks have. Here we go, new email, Kevin. Already have peaked, and they have declined. Buybacks. Okay, Kevin, your chart is in cyberspace.
As the world anxiously awaits my receipt. So give us another question, Jake. I got it, Jeff.
Yeah, because I know the options are a big part of your overall strategy, and I'm curious what level of confidence that you need to have in that space right now in order to be placing some of those trades in the futures market or just the options market in general. Just generally speaking, given the amount of short-term future uncertainty right now, how are you navigating the options market without really knowing when the end date is coming?
Well, we do the same thing whether the markets are up, down, or sideways. So the coronavirus is no impact on how we invest or how we utilize our covered calls. We use the same parameters in any instance. We trade exchange listed options, so they're very, very liquid. They're very tight spreads, very easy to transact. There's been no liquidity issues of any kind because of the mega cap space that we live in. What has helped is the fact that there's been great premiums, that the volatility has really played into our favor. We're sellers of options. We're not buyers or speculators. We're simply selling someone the right to buy our stock at a price higher than it is today. And for that, in this volatile market, we're being very handsomely compensated. But it's not a situation where we're exposed to anything different because of the coronavirus.
Gotcha. So I think what we'll do is turn it over to some client questions that we have now. So these will be for both of you. You guys can kind of tag team if you'd like, or if one of you wants to field the questions, by all means, feel free to. First of all, this is one that we've gotten from a lot of clients that we would like your input as well. but how is this, or why is this different than the '08 financial crisis that we've seen?
Because it's not a financial crisis. I mean, what took everything down, and by the way, there was a Dow theory sell signal in November of '07 that I wrote about and told people to raise cash. We actually raised 40% cash, and I still lost 8.5% in '08. There was nowhere to hide. Everything went down except cash. Precious metals went down, bonds went down, stocks went down. There was nowhere to hide, and it was a financial crisis. You had the housing blow up. This is just different. This is different than anything I have seen in 56 years of looking at markets, and it's basically unanalyzable until you get a peak in the number of virus cases. So I have basically, since we raised, well, I say we, not Capital Wealth, but I raised 30% cash in mid-January of this year. I should have raised 60% cash, which is my maximum cash position, but I didn't because I didn't think the decline would be this severe. At the time, we were only dealing with Bernie surging in the polls and a smattering of virus cases. And then we got the other thing that I think is impacting this is this spat between Saudi Arabia and Russia, and why the president doesn't pick up the phone and tell the Saudis, you know, we've had 2 fleets in the Persian Gulf for decades, and to protect you. And if you don't settle this deal with Russia and get the price of crude oil back up, guess what? Those fleets are disappearing. Why that hasn't happened is beyond me. But I think if something like that did happen, I think it would go a long way in stabilizing the equity markets.
Sounds like that conversation or a version thereof may be happening.
Yeah, I agree with that.
And if I could just follow up on that, you had talked about the number of cases peaking, and we're waiting on that information. One of the things that I've been curious as well is what economic data, or are there any other pieces of information that you are waiting to hear or find out about to give you some sense of light at the end of the tunnel?
Well, I don't know how it is where y'all live, but real estate is changing hands rather rapidly here with 4%, 4.25% mortgages. It's a buyer's market right now. The weird thing is, and most of you all know that I'm French. I drink a lot of wine. I go out to restaurants. Cheryl and I usually walk up to the Hollander and eat lunch every day, which is a hotel. There's no restaurants. They're all closed. So I went and picked up 4 cases of wine yesterday from the wine store, and I'm cooking meals again, and that needs to end, and it needs to end soon, or there is going to be an economic fallout. I'm from Detroit, Michigan. I've talked to people at the automotive companies, and businesses died. It's absolutely died. Nobody's buying cars. Nobody's buying boats. So you tell me when the virus peaks and ends, and I'll give you the economic impact.
That sounds like a fair deal.
Yeah, no, Jake. No one knows, and every pundit on TV is making assumptions and guesses. And the truth is that's the $1 million question. We don't know, and until we do, we can't plug anything into our formulas, and that's why markets are down and volatile. If we're lucky, it ends soon. But luck isn't an investment strategy, and neither is fear. So what do? You buy quality, and you get paid while you wait. You invest in the best companies in the world, and you get paid while you wait.
So that's a really good segue into a question that we've had from a client is, it's along the lines of what you just said. So you kind of answered it already, but what tools are you using to estimate forward-looking earnings, or how can we identify the amount of value that's out there right now based on these prices if we have limited earnings information?
Yeah, you can't. You just have to really bank on the history of these companies, how they've performed in previous bad times. You know, to Jeff's point, the financial crisis was a financial crisis. I mean, these banks all went under. We were just really lucky it happened on a weekend. Here, you know, we shut the economy down on purpose. And to Jeff's point, we need the economy to restart. We need people to go to restaurants, go get a haircut, go to have a cocktail, you know, eventually go see a movie. This is a strange scenario because we don't have data and we don't know the time frame. So anything that we say is arrogant to make assumptions that we know any more than the next person. But what we can do is we can look at history, look at balance sheets, look at cash flow, and make an educated investment decision on what companies stand the best chance to survive and take the least damage.
Well, it's good to hear that you guys are both echoing that same sentiment, because we're of the same opinion that we want to deal with things that we know and things that we can control, and we don't see any benefit in trying to speculate or call that specific time. So one of the things that we would like your input on, though, is a question that we had a client ask, just dealing with the overall benefit the Fed is trying to provide. So if they are increasing the dollar supply, how do you see that impacting the overall U.S. dollar, and what challenges might investors face?
Well, the U.S. dollar index, the DXY, the Dixie, went from like 90 to 103 in the past few months. It's pulled back to about par. And the U.S. dollar has been fairly strong. And I mean, the people I talk to, the portfolio managers I talk to in Asia and Europe are wanting dollars. They don't want euros. They don't want, you know, pesos. They want U.S. dollars. So in times of uncertainty, in times of crisis, people scramble for U.S. dollars. It's kind of surprising to me that gold and silver have not done better, because in my 50 years of experience in this business, when stuff like this happened, you know, gold and silver usually soared. And that, you know, are they up marginally? Yeah. But they certainly haven't soared, which is, you know, unusual. By the way, if you're looking at gold, rather than buying a gold mining company and waking up one morning and finding out that the gold mine, you know, flooded with water or whatever, you're better off buying GLD, which is basically physical gold.
Okay. This is our last question, and then we can turn it over to you guys for final thoughts. But do you think the stimulus package, not only just the plan for regular people, but also all of these forgivable loan programs by the government, are going to be enough? And what are potential long-term consequences of those stimulus programs on our country in the long run?
The people I talk to in D.C. say there's going to be another program after the ones that have already been put in place. And they're going to throw so many dollars into the economic system. What's going to come out the other side is inflation. You can't find any economic system in the history of the world that has had or going to have this much cash thrown into the system and not have inflation come out the other side.
That's great. Any final thoughts from you guys? Again, we're so appreciative of you taking time out of your day to work with us and our clients. We value our partnership with you and what you help us do. Any final thoughts for our clients to give them some words of wisdom and peace of mind?
Yeah, I have a thought. Put more money with capital wealth planning, because the kind of stocks we own, between the dividends and the tactically selling of options, is going to provide you with a 5 to 7% taxable income, and you're going to get an 85 to 90% upside capture. And typically, because the decline was so severe, we had a 73, 74% downside capture. That's not historically as high a downside capture as we get. I think Kevin will agree it's normally like 65 or 70%.
Yeah, and it probably will be as the year progresses, Jeff, because we'll have more option income each and every month. So I think for a violent, massive pullback over that short a period of time, we were well within our mandate. But thinking less of a commercial and more of where we're headed, it's clear that we don't have all the answers, and we rely on good old-fashioned common sense, which a lot of times is the best recipe for success. And I look at the world with optimism. I think when tragedy strikes, we come together as a country. Seeing that happen now, I'm anxious for Jeff and Cheryl to get back to the Hollander and be able to go outside, and I too want to go to the beach, which is closed. So this is a temporary situation. Things will go back to normal, and we will be looking back on this time as some very, very strange time in history. But let's look forward and look towards the end of it, and help one another, stay safe, and wash your hands.
And I will suggest to you that if you go back, and I'm a pretty good, in fact, Tom James, when I went into him and resigned, said, you know more about market history than anybody I've ever met. And I don't know if that's true or not, but I am a pretty good market historian. And you can go back and look at the history of equity markets back to the 1500s. And what you will see is that following every panic decline, there has always been a recovery, and a substantial one.
I think that's a perfect note to end on.
Jeff, you're always the best. Well, this is Keisha Sandrini again, and, capital wealth planning and Shillin Wealth, we really appreciate your time. Hope that you guys gain some insight, and more importantly, stay safe and healthy. And thank you guys. Have a great day and the rest of your week.
Thank you, everyone.